Okay. Well, let's go ahead and get started. I think we've got a full quorum here, so I'll make some introductions, be respectful of your time, and we'll go ahead and start the webinar. So thank you for joining today. This is another one of the classes offered by Preferred CFO. They're pro bono. And it's just really to be able to teach CEOs what they should be asking for, and CFOs and controllers, members of the finance team, how to be able to provide greater guidance and return on investment and profitability, which is today's topic, to their companies. My name is Scott Crawford. I'm a partner with Preferred CFO. Tara Chrisman, who is monitoring, will be the admin for today. So today's topic is the secret sauce, improving profitability. This is one of my favorite topics, and we do refer to this internally as the secret sauce. So it'll be presented today by a member of our CFO team, Hunter Vance. Expect we'll spend about 40 to 50 minutes in this webinar. Please use the Q&A feature if you have questions. Tara will monitor those questions and will consolidate them. There may be some, I'll also do that. Also, if it appears to be very timely to the section that Hunter's presenting on, we may interrupt Hunter, or he may ask for questions. Otherwise, we'll save some of them for the end. If you have questions about how what we're going to share today applies to you, we are more than happy to be able to give you some one-on-one pro bono time. You can just put a note in chat or in the Q&A. We'll send you a Calendly link, or we'll reach out to you. We're happy to do this. We can educate, but sometimes it's, all right, I understand, but I'm not sure how to use it myself. There will be a new schedule published. We have no class schedule for December because of the holidays. Well, there'll be a new schedule published for first quarter 2025, and we'll distribute to all of that schedule to all those that are on our list. So with that, let's turn the time over to Hunter. And again, if you have questions, use the Q&A feature, and we will make sure those questions get answered. So Hunter, time is yours.
Thank you, Scott. Thank you, everyone, for joining our webinar today, Secret Sauce, Improving Profitability. Like Scott mentioned, I'm going to be going through a number of different slides, and I'm going to want to do an exercise or two where I would hope that you participate and, as prompted, mention things in the chat that you see that point out to you. I think if you participate in a couple of the exercises, hopefully this will be of value to you. Also, feel free to use the Q&A as questions arise. For the ones that Scott identifies, we'll look at those immediately, and for all other ones, we'll take a look at the end as time permits. Before we jump in, everyone is always wondering how to improve the profitability of their business. The truth is there's no one single thing that any business can do to improve their profitability, but the goal of this is to illustrate and show how good information, good accounting, good numbers can allow a CFO or a CEO to be able to make the adjustments, make the tweaks needed within their company to increase that profitability, rather than just blindly guessing and making decisions without the proper information. So to get started, just want to go over a couple of the things we'll look at. I want to talk about cost accounting, what it is, how it differs from typical accounting, why it's important, and why you definitely should be using it. Quickly talk about a couple of different types of costs and how they react. Some of those are variable and fixed costs, why they're important. Business operating leverage, why that's something that you should be familiar with, how your business is, what type of operating leverage your business has, so that you can have a set expectation and an understanding of how to grow your business and how to improve the profitability of that business. And then we'll get into some of the secret sauce, how some of this applies. We'll do an activity where I'll show a couple of different financial statements, a couple of different views, and you guys can take a look at it, put in the chat how you think this business how we'd be able to improve the profitability of each business, and see how your answers change as different views are given. Finally, we'll take a look at a couple of the key takeaways at the end, and then we'll do a little bit of Q&A as time permits. So the first thing we wanted to take a look at is cost accounting. I think that's something a lot of people have heard, and some know what it is, some don't. But as a general idea, cost accounting is a type of accounting that breaks a company's total costs out between variable and fixed costs. So when you typically look at financial statements, you'll see all your revenues, you'll see your cost of goods sold broken out separately, and then you'll just see all of your other operating expenses. In cost accounting, you're going to split those operating expenses out between variable and fixed costs. And I'll get into kind of the differences between those and how they behave and why they're important a little later on. As noted here, cost accounting is not compliant with GAAP, so it should only be used internally. Obviously, we're going to need to follow the rules with GAAP, but if cost accounting is built properly in your accounting system, it's well thought through, it's well thought out, you should be able to have both views within your accounting system so that as needed, you can present financial statements to investors with GAAP compliance, and then also internally be able to pull reports that will help you make managerial decisions. Like I mentioned, GAAP is meant for external users and cost accounting is meant for management. So both are really important, but both have different usages and will help you accomplish different things. So quickly, I want to get into a couple of the different types of costs that we'll have. Some of the most common categories are listed here: fixed costs, variable costs, direct costs, and indirect costs. But at the end of the day, cost accounting is meant to meet the needs of your particular business. Unlike GAAP and unlike the accounting that most people are familiar with, cost accounting doesn't really have any rules. It's mostly, you build it based on the questions you need answered within your business. So that's going to vary between different businesses, different industries. There may be certain things within your business that you need answers to that other businesses it may not be as important. So when you build your cost accounting out, you want to make sure that it answers the questions you need answers to and is tailored particularly to your business. Now, that being said, these 4 different categories are very common ones. I don't want to get into too much of the nuanced different types of costs, but these 4 are ones that you definitely should be familiar with and how they behave. The first one are fixed costs. These are costs that don't vary on the level of production. So the example here are lease payments or rent. Let's say that your revenues increase dramatically from one month to the other. Well, unless you need to get a much larger facility or bigger offices, those amounts are not going to change whether you do $0 in revenue or whether you do 3 times in revenue. Now, in the long term, those fixed costs can increase, but over the short term, like a lease payment is going to be flat for whatever the term is. So that's an example of a fixed cost. They're not going to vary from month to month. Overall, they're going to stay the same each month. Variable costs are the opposite. These are costs that are directly tied and directly vary on the level of production. So commissions I have here is a very common example of a variable cost. Most of the time, the commissions are paid on revenue or some sort of revenue drives them to some degree, whether it's gross profit or gross margin or revenues exactly. But as revenues increase, typically you're going to plan on your commission expenses increasing, and if revenues decrease, you can typically plan on your commissions decreasing. Those first 2, fixed and variable costs, extremely important to understand how those 2 operate and identify fixed and variable costs within your company. And I'll get into some more of that as well a little bit later on, why that's important. Direct costs are costs related directly to a specific product. So we're typically pretty familiar with that. Usually these are costs of goods sold, or there are other costs that are directly attributable to a particular project or a particular product line. So the example I have in here is in a labor business, in a services business, the labor cost of an individual on a billable project, that would be considered a direct cost because you can directly tie the dollars that are being paid to that person to the project or the product line that they're on. Whereas indirect costs, they're the opposite. They can't be directly linked to a product. An example of that would be a company's accountant. You're not going to be able to directly link a company's accountant that's doing the AR, the AP to particular customers. So pretty typical of a company, they would refer to indirect costs as overhead. Direct costs are typically going to be cost of goods sold. All right, so kind of tying some of this together gets us to business operating leverage. So I'm just going to read this one. Understanding your company's variable and fixed costs will allow you to know and play into the degree of operating leverage your company has. So as a general guideline, if you have high fixed costs, your business is going to be a little bit riskier, but you have much higher profit potential. Whereas if you have low fixed costs, your business is going to be less risky, but you have lower profit potential. So when I mean more risky, I mean you run the risk of losing money on a monthly or yearly basis if you have high fixed costs. But if your fixed costs are very low, there's much less risk that you're going to lose any money on a monthly or yearly basis. So I have a couple of illustrations here on a high fixed cost business and a low fixed cost business. So with this high fixed cost business, the one that I looked at that's really easy to understand is a car wash. A car wash typically has high fixed costs. They need to pay their rent, basically their facilities, and then they'll have some lower, or they're going to need to have someone on standby to help all the time. And then they're going to have lower variable costs because it's just water and soap. And obviously I'm simplifying this, but most of a car wash, the expenses are going to be fixed costs. So in this example, this car wash would charge $10 per wash and have $10,000 per month in fixed expenses and variable expenses of only $2 per car wash. This would give them an 80% margin. In order for this company, this car wash to break even, they would need to do 1,250 washes each month before it started profiting. So if this car wash does less than 1,250 washes per month, they're going to lose money. If they do more than 1,250 car washes per month, they're going to be making $8 straight to their bottom line every single car wash above 1,250. So this car wash has limitless profit potential once it gets over those 1,250 washes. On the other end, a company with low fixed costs would be an online clothing company. They're not going to have a brick and mortar. Their fixed costs are going to be very low, and their variable costs are going to be what makes up a majority of their costs. So in this example here, we have a company that sells shirts for $12 with only $1,000 per month in fixed expenses and a cost of $8 per t-shirt. So this would leave them with a 33% margin. The company would only need to sell 250 shirts before it started profiting. So it's much less risk. Even if they don't sell a single shirt that whole month, the most they could possibly lose, and obviously this is a simplification, but the most that they would lose is $1,000. Whereas with the car wash, the most that they would lose is at least $10,000. Now, on the flip side, if the car wash does $30,000 in revenue, it would make $14,000. That would be a 47% net income margin. Whereas if the clothing company does $30,000 in revenue, the exact same amount of revenue, it would only make $9,000 in profit. This would be a 30% net income margin. Now, if the car wash only did $10,000 in revenue, it would lose $2,000. And if the clothing company did $10,000 in revenue, it would make a little over $2,000. So understanding how your company is set up, whether it's fixed, whether it's variable, the degree of operating leverage is going to give you an idea of what your break-even point is. It will help you understand what type, how many of a certain item that you need to sell to become profitable, and then how much you're going to be able to scale once you meet those fixed expenses. Are there any questions up to this point? Scott, do you see anything that's come through? You're muted, Scott.
I just had one question I could see that I thought was pertinent to the conversation at this point in time. And that was, can you separate out these fixed and variable expenses and direct and indirect in QuickBooks?
Um, yes and yes and no. Well, so one way that there's many different ways you can do it. Within QuickBooks, to my knowledge, you wouldn't break them out. You wouldn't assign one a variable expense or a fixed expense, but what you can do is in your GL, you can put in there, let's just say, for example, you have advertising expenses. Maybe you have $3,000 per month that's fixed, and maybe you have another amount that's variable depending on the amount of revenue you would do. Rather than just lumping it all into advertising expense, you could have one that's called variable dash advertising expense and one that's called fixed dash advertising expense. And then they could be part of a parent that would, when collapsed, they group up into just total advertising expense. But when you break them out or you expand the detail, it will show you how much is variable, how much is fixed. Now that would accomplish making it so that your financial statements are still GAAP. But then also, if you expand all the detail, and you probably want to export it at that point to be able to kind of group the detail a little bit differently, you still have all the level of detail you would need to be able to break things out between variable and fixed. So that's one way of doing it. Another way is you can use classes. There's other things that you can do. QuickBooks itself is not built out to break things out between variable and fixed, but if you use a little bit of elbow grease, you can build it out in a way that you'll still be able to identify between the two.
Hunter, is that chart of accounts set up? Is that what you're talking about?
Yes, yeah. So in your chart of accounts, like I said, if you're careful about how you build things out in your chart of accounts, you can build things out and just in the name call something variable or call something fixed. And then you can have them grouped out that way. So like for example, you could have put all of your variable expenses as starting with the number 2000 or something. All of your variable expenses starting with the number 2000, they're part of a parent called variable expenses. And then you could have another one called all of your fixed expenses starting with 3000, for example. They're part of a parent called fixed expenses. So you would have up above, you would have variable expenses for advertising, and then down below you'd have fixed expenses for advertising. They're all going to roll up together, and so it'd still be GAAP compliant. It would just be separated out within those different parents.
Thank you.
Yeah, let me know if that answers the question or if additional clarification is needed. But again, sometimes you have to get creative. QuickBooks isn't really built out for a ton of crazy pivoting, but if you're creative with the chart of accounts, then it can easily be accomplished, breaking things out between fixed and variable. Any other questions are on there, Scott?
Couple others, but I think they're going to be answered because I know the subject, I think, so I'll hold them to a little bit later.
Okay, so the next portion of this presentation is to kind of try to bring everything together and help understand why all of this even matters. Why does it matter if we break things out between fixed and variable? Why can't they just all be together? So I have an exercise, we call it the secret sauce. I'm going to show you 4 different views of the exact same financial statements, but they're broken out a little bit differently each time. They're categorized a little differently. You'll notice that the margins, EBITDA percentages, all of that stuff, they're all the exact same numbers, but they're categorized differently. And each view is going to be able to give you a little bit different insight on how to improve the profitability of this business. So the first view I'm going to show you is your typical financial statements. Next one is going to be some basic cost accounting. Next one's going to be profit by product. And then the last one's going to be profit by customer. And you'll see that, again, they're the same numbers, but you'll see that as they're broken out differently, it's much clearer, much easier to understand what needs to be done to move the needle to improve the profitability of this business. So for each one of these, Scott, maybe you can set a timer. I'll show you the view. Let's look at it for 30 seconds. And then if you guys can put in the chat things that you think based on this view need to be done to improve the profitability of this business, I'll give you a couple of my thoughts. And then we'll go on to the next view and we'll kind of do the same thing over again. And your answers will likely change as additional information is presented in different ways.
Okay, 30 seconds.
So here's the first view. This is very typical of what you would see. You have your revenues, you have your cost of goods sold, and then everything that's any expense that's not a cost of goods sold, you'll see down below here in operating expenses. See the EBITDA percentage is, well, you'll see that the gross profit margin is 64%. Really good. I mean, look, and that's typically going to be a really good profit margin. And then your EBITDA percentage is 11%, depending on the industry. That may be good, that may be bad. And then based on the information that we have here, the break-even revenue is 186,000. So in other words, with this information that we have here, the best that we can estimate, the best we can guess is that this company will need to do $186,000 in revenue before they break even.
And by the way, Hunter, the screen, at least my screen cuts off. I can't. Oh, there it is. Okay, I can see the 186 at the bottom. So it's been a little over a minute. So, and that would be your opportunity to be able to let's put it in chat so everyone can see, if anyone wants to participate, how this company with what you have there would improve profitability.
Let me see if I
just put mine in there. Sell more at a higher price. I think some people may be using Q&A, and that's fine also. I mean, this is kind of a tough one, Hunter, because I mean it's almost one of those. Yeah, there we go. Sell more. I agree with that comment. This is one of those that they got great margins, sell more, but there's not a lot of revelation here, Hunter. So I think we're all kind of in the same mindset. Sell more. If you can improve margin, please do it.
Perfect.
I'll
Okay,
let you on to number 2. We'll time it
it's
again.
hard to know. It's hard to know what to do besides sell more or let's cut some expenses. Hard to know what to do. And these are your typical financial statements that you would see. This is what your P&L would look like. It's hard to know what to do if you give someone this view. What am I going to do to improve the profitability of this business? So let's move on to the next one. This one should be a little bit more insightful. This is an example of your basic cost accounting. You can see that the margin is the same, 64%. EBITDA percentage is 11%. You'll see one of the differences here is that we have variable expenses broken out, and then we have our fixed expenses here down below. So you'll note that this 14,000 of our variable expenses or of our advertising is actually variable, and only 3,000 is fixed. A little bit different insight than what was given in the first view, which would mean if these are categorized properly, that if our revenues if our revenues went down, then our advertising would go down proportionally, except for that $3,000 in fixed expense. Another item to note here is that we now have a contribution margin. A contribution margin is really important to understand when you're trying to understand, when you want to know how to grow your business, how to scale it, how to improve the profitability of that business, because contribution margin is going to tell you how much of every dollar in revenue you generate goes to covering fixed expenses. So in this example, contribution margin here is 30%, meaning for every additional dollar in sales I do, 30 cents of that will go to cover my fixed expenses. Now, when there was a comment that the gross profit margin is really good, 64%. Well, when we bring in some of these variable expenses, we understand this company is a lot more variable than we may have initially understood. It has a 30% contribution margin, which before, in the prior view, we'd assumed it had a 64% profit margin because there was no other option. And now we're able to determine that this company truly has $141,000 break-even point, as opposed to, I think it was 180,000, which that was a little bit different story. Any other comments in the chat, Scott?
Yeah, I know. Tara's looking at what the Q&As, but this is interesting, Hunter, because I had always understood that it took me a long time to figure out the difference between that first view where it was 186,000 was break even and this view where it's 141. But it's because I've come to understand, please correct me if I'm wrong, the variable expenses change automatically. So if you change that number at the top from 225 to 141, the variables would adjust automatically, but the fix remained the same. And that's why this is a true number, whereas the other one was not. So, it's nice to know break even, but I think the real meat's coming next.
Yeah, so a couple more things. By seeing it this way, it's easier. We understand that this has much higher variable expenses and lower fixed expenses than we anticipated, or we thought before. We have 42,000 in fixed expenses. And at this point, we can start kind of taking a guess as to what might move the needle. Our commissions are pretty high. Is there a way that we can reduce that? Our marketing is pretty high. Is there a way to reduce that? Maybe, do we need all of these salaries and wages? Those are fixed. Do we truly need all of them? So a little bit more insight, but like Scott said, the next view is going to help us understand how to move the needle much more to improve the profitability of this business. Okay, so this view here is profit by product line. So this is a little bit busier. Just to walk you through it, this total column here, this is what we saw in the last slide. They're the exact same numbers. This is all breaking everything out by product line, breaking these totals out by product line. So this is detail of what's here in this total column. So of this 225,000, 90,000 is product A, 50,000 product B, so forth. EBITDA of the 24,000 EBITDA, 14,000 is attributable to product A, 18,000 to product B, so on and so forth. So I'll give you guys a minute or so to take a look at this one. There should be some pretty obvious things we can come up with on this view that's going to help us understand how to move the needle in improving the profitability of this company.
Yeah, and if you want to submit those just to Tara so she can see those, put them in Q&A. If you want to share them with everyone, put them in chat. And the question is, if you now have this information as a company, how do you improve your profitability? Knowing that you've got these 4 primary product lines, and this is how they are contributing to the profitability of the company.
So as you guys are submitting some of those answers, a couple of really obvious things are product A here makes up 40% of our total revenue, our total sales. Of the 225, Product A makes up 90,000 of our sales. But if we look here at our profit margins, it has the lowest profit margin. So we know that product A costs more than products B, C, and D. It costs more. And as well, we have higher variable expenses for product A. So the actual product itself costs more and it takes more in advertising, commissions, consulting, marketing, all of these things, 37%, than our other product lines. They're only 32%. That leaves us with a 19% contribution margin. So in other words, for every dollar that we sell a product A, 19 cents is going to cover our bottom line, which is a much lower contribution margin than our other products here. Our overall contribution margin is 30%, and our biggest seller is really dragging that number down to 19%. In addition to this having the lowest contribution margin, we also have a fixed cost that's associated with product A. It's a consulting cost that we have here. And that could be, we have for product A, we have a rep that, or a consultant that, helps us with product A and product A only. If we got rid of product A, that consultant would go away. If we keep product A, that consultant's going to cost us $3,000 per month, no matter how much we do in sales. Yeah. When we get through all of that, when we get to the very bottom line, product A only has a margin of 16%, whereas our EBITDA percentage of 16%, whereas these other products have much higher percentages. So another couple things to look at here is that our commissions, $12,000 of our commissions is going towards product A, which barely makes us any money. That's half of our commissions that we spent here. Same thing with marketing. We're spending a ton in marketing for product A, and we're not really making that much money on product A. So the takeaway from product A here is, looks like we're investing a lot of time. We're focusing on product A. We're spending a lot in commissions, a lot in marketing. Every expense is higher, and we're selling a lot of it, but it's not very profitable. And so with product A, at this point, you have a couple of decisions to make. One is, do we get rid of product A? Now, that may or may not be the right answer. Another obvious solution is, hey, maybe we should start we should start charging more for product A. Our profit margins are really low on product A. Maybe we start charging more. Another option would be like, hey, why don't we look at product D? We only sell 11% of our revenues come from product D, but it has a 43% EBITDA percentage. Maybe we start focusing more on product D and less on product A. These margins are much better. They're the highest margins that we have of all the products. What can we do to push product D more?
So Hunter, I see that the comments that have come back in are kind of the same. How do we improve profitability of the company? Well, we sell more of product D, it's more profitable. We sell more of product B, it's more profitable. But let's focus on product A. It's our most popular product, but we want to improve that profitability. That's one of our actions now that we have this information. So I think that's where we go on the next one, right? View 4 is how to improve profitability of product A.
Yes. Yep. So in focusing on, obviously there's a lot of different things you can do, a lot of different questions to ask yourself as you have all this information. And on view 4, let's take a look at why product A isn't as profitable as the other lines. Is this just a bad product, or is there something more to it? So this next view is going to be a breakout of product A. If you remember, this is the total of product A. So the EBITDA for all of product A is 14,000. And then we have 6 different customers here that make up product A, and are going to explain why product A is not performing as well as the other products. So I'll let you guys take a look at this for 30 seconds or a minute. There should also be some pretty obvious conclusions we should be able to draw from this view as well. While you're looking at this, it might feel like it may not be feasible, or you might not be able to build this out in QuickBooks, which is a lot of our clients use QuickBooks. It's simple, it's easy. It may feel like you might not be able to break this out in this much detail in QuickBooks, but it's 100% possible. We've done that with multiple clients. Have things within their QuickBooks showing profitability by product, profitability by customer, export that into Excel or Google Sheets and pivot it some more to look at additional reasons why or why not a certain product or customer is profitable. So all of this information can be tracked, and it's actually not, depending on the complexity of the business, it's very doable, very feasible. It just takes some thought, and you have to be careful in the way that you set it up, and you can have these same views even if you're using a simple software like QuickBooks.
So, Hunter, the questions that are coming back are obviously, do I need customer A? I think I threw that up there as well. To my eye, you barely break even on customer A. Now, maybe that's a loss leader, but if you know that's the case, that's fine. Can you make more? Is another question. If you can make more, then you could sell them to customer 3, which is obviously your most profitable customer. And then obviously customer 1, 2, and 4 are much the same, but maybe you're constrained. So I think those questions are really dependent upon each customer or each company. But maybe you can't make any more. Maybe customer 6 is sucking up all of your inventory, and that's why you can't sell to more profitable customers. Don't know what the answers are, right? But it just depends upon having this information, what decisions to make, correct?
Yeah, 100%. So just like you touched on, Scott, customers 1 through 4 are pretty profitable. They have high contribution margins. There's no fixed cost directly attributable to those customers. They have really high margins. Customer 5 and customer 6 have much lower margins, but they make up pretty much all of the revenue of product A. So the question is product A, is it a bad product, or did we get stuck in some difficult deals with customer 5 and customer 6, or customer 6 might be a Costco where we're very limited and we can't charge nearly as much, but we're producing a lot. And the question then becomes, is it worth doing? Is 45% of product A, is it worth making $240 per year for all that work that we're doing? Like you said, it might be a loss leader. It may be, or it may be time to move on from customer 6 and start spending more time on other customers. The point is, when you're able to see things at this detail, you know how to move the needle, where to look into, and what you can potentially do. Whereas that very first view, they're the same numbers. All these numbers tie out, but you look at it and you don't have any idea how you're going to improve that 11% EBITDA margin. Whereas when you get into some more detail, understand by product, by customer, it becomes a lot more clear where you need to focus your efforts. Scott, are there any other questions or comments on this view in particular?
I'm not sure what you have next. I might save these for the end because you may answer them just in your normal course. So I'm going to say let you go ahead and finish up, and then we'll do the Q&A at the end.
Yeah, and we're just wrapping up here, but a couple of the key takeaways, some of the most important things I'm hoping that are understood here is that informed managerial decisions can't be made just using GAAP financial reporting. You need to use cost accounting. You need to have more insight as a CFO, as a CEO, so that you know how and where to make decisions that will actually move the needle as opposed to just guessing and hoping. Cost accounting can be tailored to your business, and it will drive decisions that will directly impact your profits. So kind of what I touched on before, understand how much is variable, understand how much is fixed. It's going to get you to a contribution margin. It's going to help you understand how much in revenue, how much $1 of revenue is going to contribute to the bottom line. Same thing here, breaking out variable and fixed expenses. A company may have multiple profitable lines, but one or two less profitable ones are holding the business back, which is exactly what we saw in product A. Product A may be a very profitable product, but we have one customer or two customers that make it look really bad. And without understanding the breakout between customers, you might say, let's just cut product A completely. But when you look at product A by customer, you can see it's just one customer that's causing all these problems in this business. And that's what we need to look at, not the other products or product A as a total. And then following up on that, not all customers are created equal. Understand which customers are adding to the bottom line, which ones are detracting from it. You might need to fire a customer sometimes. And that's not always the answer, but that sometimes may be the answer so that you can focus on more profitable ones. Those are the key takeaways. I have a couple of common questions, but at this point, this is probably a good time to do some of the Q&A, Scott, if there's anything that's come through in like how to implement things into QuickBooks. We kind of touched on that a little bit, which is better, what high operating leverage, low operating leverage. How do I know if I should fire a customer? Now, those are a couple of questions that I get pretty consistently. Do we have other questions, Scott, that have come through?
So there's a few questions here, Hunter, but the one I'm going to actually start with is who in the financial team, I'm adding some words here, but the question is who should do this calculation? And so I'm going to say who in the financial team should do this calculation?
So it should be an effort of the whole financial team directed by the CFO or the controller. It's a lot of this detail is going to come from how the bookkeeper categorizes things. So it's got I guess short answer, it has to start from the top. The CFO and the CEO need to work together to understand what it is that they want to see. Like I mentioned in the beginning, cost accounting, it's tailored for your business. So you need to understand, what do I want to see? And then from there, the CFO and the CFO can work with the controller, directs the controller on how to set things up, and then the controller is going to oversee and make sure that the bookkeeper is classifying things properly, make sure that that person is properly trained. And so I guess short answer, it's a team effort, but you have to know what you're trying to accomplish before you can set it up and train people properly.
So there's a couple of more questions, Hunter, about how do I know whether it's a variable expense or a fixed expense? And what's the problem with just dividing fixed or overhead by a revenue percentage of different products or divisions? But I might even shortchange that a little bit just by saying that, if the person asking this question is the CFO, there may be a knowledge or experience base there. If the person asking the question is the CEO, that would be a question you'd ask your CFO, right?
Yeah, so the simplification of just dividing your operating expenses by revenue, and that's what we saw in the view number one. And it doesn't give you a very reliable break-even point. If you remember, it told us that we needed 185,000 to break even, when in reality, when we broke things out properly, it's only 140,000. Now, that's a positive difference, but just as often it can be a negative difference where you think that you need to do $200,000 in revenue to break even. It turns out you got to do 400,000 because things aren't broken out properly between variable and fixed, and you go along with that goal of doing 200,000, you get to the end of the month or the end of the year and you lost a bunch of money and you can't understand why. And it's because you didn't understand how your expenses operated and how they reacted to revenues. So that's great as a back of the envelope, but you can be high or low very, very easily if they don't react the way that, if they aren't all variable expenses, essentially.
So Hunter, maybe just as we wrap this up, there was a question about how do I know if applies to me? And I'm going to direct it back to a conversation that you and I had a year and a half or two ago because we were presented with a book called Islands of Profit in a Sea of Red Ink: Why 40% of your business is unprofitable and how to fix it. So this author represented that 40% of a typical business's products or services were unprofitable. And we had a discussion in our finance team, our CFOs, about whether that was a true number, 40%. And if I recall, your synopsis and the other team's synopsis was it may not be 40%, but nearly every company has some product or services that are unprofitable. Is that correct?
Yeah, 100%. And the worst part is that unless things are broken out properly, you don't know what's unprofitable. And so you might think, just like that first view, you might think, well, we're doing a ton of product A. Maybe we do more of product A. We need to do a lot more of product A, or we do tons of business with customer number 6. Why don't we see if we can do a lot more with them? Because they make up a lot of our revenues. And by doing that, you actually are going to get in an even worse situation, and your profitability is going to decline even more. You're going to have no idea why. And the only way you can know how to pull the right levers is to have the numbers on each of those potential levers to pull.
Yeah. So this is both this is how you reveal the problem and you solve the problem. So this process of contribution margin and then product line analysis and customer analysis will tell you whether you have a problem or whether you do not. So if you would like any additional information, if you'd like a copy of the slides, just contact Tara Chrisman. Tara, if you wouldn't mind putting into chat, I don't know if everybody can see that, or you can respond to the invitation that's sent out each month that you'd like slides or more information from today's presentation. And then again, there'll be a new schedule for new classes that will be announced for Q1 of 2025. Again, no web class next month. So thank you very much for joining. It's good to see many of you here as repeats. And we wish you the happiest of holidays and look forward to seeing you next year at the last Monday of the month for our next class. Again, Tara's put her email into the chat. It's Tara, Tarac at preferredcfo.com if you want slides or any other information. Again, happiest of holidays. We'll see you this next year.